Welcome to episode 15, where we tackle the dark side of the markets. Today we are discussing red flags and fraud. We will look at how over $100 billion in shareholder value simply vanished into thin air, and more importantly, we will learn how to spot the warning signs that were hidden in plain sight all along. Fraud is never a victimless crime against some faceless entity. It destroys real lives and shatters trust. Consider Enron alone, where shareholders lost $74 billion in the 4 years leading up to their December 2001 bankruptcy. Retirement accounts were completely wiped out, and employees who put their entire 401k balances into company stock saw their life savings evaporate in weeks. Even the accounting industry suffered, as Arthur Andersen, one of the 5 largest firms in the United States, collapsed entirely, costing 85,000 people their jobs. Understanding these red flags is not just a theoretical exercise, it is essential self-defense for every single investor in these markets. To understand how fraud happens, we are going to examine 4 landmark cases from the last 2 decades. We have Enron, the energy trading giant in Houston that hid debt in off-balance sheet vehicles. Theranos, the Silicon Valley healthcare firm that raised over $700 million on fake technology. Wirecard, the Munich payment processor that reported profits from phantom partners. And FTX, the Bahamas-based crypto exchange that commingled $8.9 billion in customer funds. While the industries and specific mechanics of these 4 frauds differ, the underlying warning signs are remarkably similar. By looking at these patterns, we can learn to protect our own capital from the same traps that caught even the most sophisticated investors. Enron's primary weapon was mark-to-market accounting, a method approved by the Securities and Exchange Commission in 1992 for energy contracts. This allowed the company to record the entire estimated lifetime profit of a long-term deal on the very day it was signed, even if no cash would actually arrive for years. If those projections changed, the adjustments were buried in footnotes or ignored entirely. While this accounting practice is standard for banks and insurance companies, Enron weaponized it by using inflated internal valuations for illiquid, long-dated contracts that had no observable market price. The result was a massive divergence where reported earnings grew exponentially while actual cash flows remained flat, bearing no relationship to economic reality. To keep their balance sheets looking pristine, Enron's chief financial officer Andrew Fastow created special-purpose entities with names inspired by Star Wars, such as Jedi, Chuko, and Raptor. These structures were used to move debt and underperforming assets off Enron's books. The fatal flaw was that these entities were collateralized by Enron's own stock. When the share price started to fall in 2001, the entities could no longer cover their losses, and the hidden liabilities snapped back onto the company's books all at once. Fastow also personally profited from these, creating a conflict of interest. While the company reported $690 million in debt, the real story was hidden in the footnotes that almost nobody read. The collapse was swift and brutal. In August 2001, CEO Jeffrey Skilling resigned after just 6 months, citing personal reasons. Shortly after, Vice President Sharon Watkins sent an anonymous memo to the chairman warning of an accounting scandal. By October 16th, Enron reported a third-quarter loss of $638 million and a $1.2 billion reduction in shareholder equity. The SEC investigation began immediately. By November 8th, they were restating earnings all the way back to 1997. On December 2nd, less than 4 months after Skilling left, Enron filed for Chapter 11 bankruptcy. The stock, once worth over $90, plummeted to less than $1 per share. The impact of the Enron scandal was so severe, it reshaped the entire accounting industry. Arthur Andersen, Enron's auditor for 16 years, was indicted in March 2002 for destroying evidence. Although the Supreme Court later overturned the conviction, the firm had already disintegrated, leading to 85,000 layoffs and the collapse of the Big Five into the Big Four. Congress responded with the Sarbanes-Oxley Act of 2002, which mandated that CEOs and CFOs personally certify their financial statements. It also required independent audit committees and strict internal controls under Section 404. If you look at a 10K filing today, you are seeing the direct regulatory fingerprints of the Enron collapse. In 2003, a 19-year-old named Elizabeth Holmes dropped out of Stanford to found Theranos. Her promise was revolutionary, a device that could perform over 200 blood tests from a single drop of blood. By 2014, she had raised over $400 million and reached a $9 billion valuation, making her a paper billionaire. Major retailers like Walgreens and Safeway signed high-profile partnerships, betting on a young visionary disrupting a stagnant industry. There was just one problem: the technology never worked. Theranos was secretly using commercially available equipment from other manufacturers to process their tests while claiming they had developed a proprietary breakthrough. It was a $9 billion illusion built on a foundation of lies. The house of cards began to crumble in December 2014 when the Journal of the American Medical Association noted that Theranos had never submitted its technology for peer review, which is the gold standard for scientific validation. Theranos refused to provide evidence, citing trade secrets. When the FDA finally investigated, they found the company was using an uncleared device that had never been validated. By 2015, the Centers for Medicare and Medicaid Services inspected their facilities in Newark, California, and discovered that the lab was a hazard to patient health and safety. The company had operated for over a decade without producing a single piece of independently verified clinical evidence to support its claims. The board of directors at Theranos was a masterclass in misdirection, featuring heavyweights like Henry Kissinger, William Perry, James Mattis, Sam Nunn, Bill Frist, Richard Kovacevic, and Riley Bechtel. While these are impressive names in politics, the military, and banking, not one of them had any background in blood testing, laboratory medicine, or biotechnology. When a healthcare company is governed entirely by people who cannot ask the right scientific questions, there is nobody to challenge the founder. Traditional biotech investors, who actually understood the science, largely stayed away from the company. That absence of industry-specific expertise on the board should have been the loudest warning sign for everyone involved. The lack of basic skepticism was staggering. Lisa Peterson, representing the DeVos family, invested $100 million in 2014 without ever visiting a lab or hiring an independent expert to verify the claims. Similarly, PFM Health Sciences, a fund specializing in healthcare, was denied a tour of the laboratory facilities by President Sunny Balwani, who claimed it would compromise intellectual property. Despite being refused access to the labs, the Walgreens partnership, and any third-party verification, the money still flowed. This is not about being a genius investor. It is about basic due diligence. 3 separate requests for information were denied, and yet investors still handed over their capital. Wirecard, based in Munich, was once the darling of the German stock market. In September 2018, it was promoted into the DAX 30, replacing a bank that had been around since 1870. At its peak, the company was worth 24 billion euros, surpassing the value of Deutsche Bank. It processed payments for giants like Apple Pay and Google Pay, and investors viewed it as Europe's answer to PayPal. However, the growth was a total fiction. Roughly half of the company's reported profits were manufactured through a network of opaque third-party acquiring partners in Asia. The business everyone admired was, in large part, a complete fabrication. The end came on June 18, 2020, when their auditor EY announced it could not verify 1.9 billion euros in escrow accounts at 2 Philippine banks. The stock crashed 60% in one day. Within 3 days, the company admitted those cash balances likely did not exist at all. On June 25, Wirecard filed for insolvency, becoming the first DAX 30 company to do so. The CEO, Markus Braun, was arrested for fraud, while the COO, Jan Marsalek, fled the country and is believed to be in Russia. The cash that supposedly underpinned the entire balance sheet was simply never there. The sheer audacity of the fraud was revealed when investigators looked into the third-party partners. KPMG's 2020 audit found that these partners were responsible for nearly 1 billion euros in operating profit. When reporters from the Financial Times visited these offices, they found one was a largely unmanned suite in Dubai, and another shared space with a tour bus company in the Philippines. A whistleblower even provided 70 gigabytes of internal documents proving that staff had been forging invoices and backdating contracts to fabricate transactions. When this was reported to the Munich headquarters, management simply buried the investigation and continued the scheme. EY served as Wirecard's auditor for over a decade, signing off on the company every single year. The Public Company Accounting Oversight Board later found that in 2018 alone, over 27% of EY's audits contained deficiencies. When they finally attempted to verify the Asian business, auditors bought subscriptions to adult websites and purchased video game coins using prepaid cards provided by Wirecard. These merchants were selected by a Wirecard executive in Dubai, and they did not exist. Despite this, EY gave the company a clean bill of health. It took another 18 months for the truth to surface, proving that even the biggest auditors can be blind to obvious red flags. At its peak in 2022, FTX was valued at $32 billion. It was endorsed by celebrities and politicians, yet it had no in-house accounting department, and its financial statements were largely unaudited. There were no independent directors on the board, and Sam Bankman-Fried controlled every decision. Employees submitted payment requests through chat platforms, and managers approved them with emojis. John Ray, the expert who oversaw the Enron liquidation, took over as CEO during the bankruptcy and told Congress that he had never seen such a complete failure of corporate controls. He described it as old-fashioned embezzlement, noting the total absence of any trustworthy financial information. The collapse was triggered by a single article on November 2, 2022, by CoinDesk. It revealed that the balance sheet of Alameda Research, the trading firm controlled by Bankman-Fried, was filled with FTT tokens, a coin created by FTX itself. Instead of Bitcoin or cash, their largest asset was a token they printed out of thin air. When the public realized the sister company was using a self-created token as collateral, confidence vanished. The token price dropped from $22 to under $1 in days. When customers rushed to withdraw their funds, FTX could not pay them back because those deposits had been siphoned off to Alameda. It exposed an $8 billion hole in the company's finances. FTX's terms of service claimed that customer digital assets were not the property of the exchange and could not be loaned out. That was a lie. Customer deposits were sent directly into bank accounts controlled by Alameda Research, where they were commingled with corporate cash. When Alameda needed money to cover bad trades, they simply spent customer funds. Bankman-Fried later claimed the missing $8.9 billion was just an accident, saying they basically forgot. Bankruptcy filings confirmed the massive deficit, revealing that customer money had been used to cover trading losses, buy luxury real estate in the Bahamas, and fund political donations. The core of the FTX scheme was printing their own collateral. They would create FTT tokens, sell a tiny fraction to set a market price, and then record the remaining millions of unsold tokens at that same price on their balance sheet. If they had 1 million tokens and sold a few at $22, they would claim they were holding $22 million in assets. This allowed them to pretend they were solvent when their liabilities actually far exceeded their assets. Because this token was the collateral for customer deposits and the primary asset for their trading firm, once people lost confidence, the entire structure collapsed in just 72 hours. To detect these kinds of manipulations, you can use the Beneish M-Score. Developed by Professor Masoud Beneish, this model uses 8 financial ratios, including sales growth, asset quality, and accruals to spot earnings manipulation. An M-score greater than -2.22 suggests a high likelihood of manipulation, while anything above -1.78 signals a high probability of fraud. The model is statistically proven to identify 76% of manipulators. Interestingly, students at Cornell used this score to flag Enron as a fraud before the company collapsed, while professional analysts were still telling people to buy the stock. It is a free, powerful tool that you can calculate using any company's 10K filing. Another critical red flag is the divergence between net income and operating cash flow. If a company reports rising profits while cash flow is stagnant or falling, those earnings are likely just accounting entries rather than real business performance. You can use the Sloan accrual ratio to measure this. As a rule of thumb, you want to see this ratio stay between -10% and +10%. If it drifts outside the 25% range, it is a major danger signal. Also, watch for days sales outstanding rising faster than revenue, or inventory growing faster than the cost of goods sold. When these red flags cluster together, it is rarely a coincidence. If there is one common thread across Enron, Theranos, Wirecard, and FTX, it is the weaponization of complexity. They used obscure entities, trade secret claims, and confusing corporate structures to discourage people from looking too closely. They made the numbers so hard to follow that even the auditors and analysts gave up. But the truth is, if you cannot understand how a company makes its money after reading their 10K filing, you should not be investing in them. Complexity is not a sign of sophistication. It is often a wall built to hide the truth. Always remember, if it is too complicated to explain, it is usually too complicated to trust. That brings us to the end of our look at corporate fraud. In the next episode, we are going to get practical. We will cover how to read a 10K filing in just 20 minutes. I will show you a systematic method for where to look, what to skip, and exactly which 5 numbers you need to find to understand the health of any business. It is the most important skill for a fundamental investor, and we will break it down so you can do it yourself every time. I will see you in episode 16.